Thanks for joining us on this Emily Now episode. Today we're going to be talking about construction financing. What is it? What is a cost to complete mortgage? We're going to give you an example of some construction financing gone wrong that we learned about a couple weeks ago from a client that we were able to help. And we're going to talk about the Royal Bank employee pricing announcement that was made this week and what we think of it. So stay tuned. My name is Gallagher. I'm the founder of mlenow.ca. I've been in the money business for about 18 years, mostly working with banks, lenders, investors to put together mortgages and loans. And we put together these weekly Emily Now episodes to help you understand a little bit more about debt, a little bit more about what you should know about debt. And we hope that in sharing that with you that we can help you do more, because we know that if you make smart decisions about the borrowing that you need to do as either an individual or a business, that you should be able to save some money for the future, invest in new opportunities, and with all of that profit or all of that money that comes from making good decisions, then maybe you can even give it back to the community around you. So we also encourage you to visit our website, mlenow.ca, which is a web portal that will help you get prepared to be approved. You can put in your information, you can get what's called an Emily score, which you can use to line up against banks and lenders in the marketplace to see what kind of mortgage and loan options you have. And so we hope that you'll find that helpful, and to accommodate what you're doing at Emily Now, we have these episodes to help you find your way through some of the questions that come up. So let's get started. We start all of these episodes with a couple of questions, and today the question that we're going to start with is, what is construction financing? Construction financing, also known as a construction draw mortgage, is a mortgage that is advanced over time based on the progress that's being made. So for example, if you're building a home or you're building a building, instead of borrowing all of the money at once to build that structure, you can borrow the money over time. You can borrow the money as the foundation is poured. You can borrow money once the framing is done. You can borrow money once the walls are in. And the reason it's called a construction draw mortgage is because you will request draws from the bank or the lender based on the progress that is being made. So you tend to save a little bit of interest, because instead of borrowing all of the money you need at once, knowing that it's going to take half a year to a year or more to finish construction of your particular project, a construction draw mortgage allows you to only take what you need as you need it. The mortgages tend to be interest only, and I'll compare that to the other type, which is what's called an amortized mortgage. So with every payment that you make, a little bit is interest, a little bit is principal, and over time, 20 years, 25 years, you end up paying the entire mortgage down. With an interest-only mortgage, it works more like a credit card, where you'll have a balance, and then based on a certain interest rate, that's the payment that you make. And there is no principal, it's only interest. And construction draw mortgages or construction financing tends to be priced based on interest-only payments. Once construction is done, then the mortgage will convert into, or many times, the construction mortgage that you had will end up converting into a more traditional amortized mortgage over 20 or 25 years, or if you're building a building, maybe 15 or 20 years. When you get a construction mortgage, you're going to have to produce a budget for the bank. And the bank is going to want to see three basic categories in your budget. They're going to want to see, what did you pay for the land? What are your hard costs? And what are your soft costs? So land is pretty straightforward. Or hopefully it's pretty straightforward. That is the physical piece of land that your structure is going to be on. And so the bank's going to want to know, how much did you pay? How much are you paying for that? Then they're going to want to know, what are the hard costs and what are the soft costs? And hard costs, the easiest way to understand it would be anything that you can see on the structure is a hard cost. Wood, nails, drywall, shingles, flooring, plumbing, wiring, those are all hard costs. And then soft costs would be anything you can't see in the structure. Legal fees, appraisals, permits, drawings, architects, interest, bank fees, all of the kind of the soft stuff. So when you put a budget together, you need to know your land, your hard costs, and your soft costs. And the banks tend to like to fund land and hard costs because those are tangible assets or they have tangible value. Soft costs tend to be a little bit more arbitrary. And to give you an example, a home that I was involved in constructing, we had paid a couple of $1,000s to have some floor plans drawn for us so that we could give them to the trades so that they could build the home. Well, I know from other projects that I've funded that sometimes those costs can be tens of thousands of dollars. And so the reason banks don't like funding soft costs is because it's very difficult to try and figure out, okay, what is the true value of this particular cost? When they talk about land, banks can say, well, there's lots of other pieces of land that we can look at and we can sort of get a handle around what the cost is. And wood and nails and drywall, we can kind of understand that those costs are what they are, concrete, etc. But soft costs tend to be something that the banks do not like funding, or if they fund it, they'll only fund a certain line items like interest, for example, but they tend not to fund legal fees or appraisal costs or architects or permits or anything like that. So when you get a construction draw mortgage, you should know that the interest rate might be a little bit higher than what you would normally expect for a mortgage when you see mortgage rates posted everywhere. Construction mortgages tend to be a little bit more expensive because they require more work on behalf of whoever the bank or lender is to manage it. And you're going to find that there are probably going to be some fees associated with it. Some of the banks will charge up to 1%. Private lenders will charge a couple of percentage points for the fee. Mid-market lenders, the same thing. So when you're looking at a construction draw mortgage, just be aware that it may be more expensive than the traditional mortgage that you might be used to getting. The second question that we're adding to today's episode is, what is cost to complete, or what does cost to complete mean? And that's a term that if you're looking for a construction mortgage, you're going to hear that all the time, and it's going to be sort of a very casual term that people will use. But basically this term, it's associated with construction mortgages, and the best way to explain it is to give an example. So if you have a building, something that you're constructing that you've gone to the bank to look for financing for, and it's going to cost $500,000, and you're going to put in $150,000 towards the cost of $500,000. That means the bank, or you're going to look for someone to lend you the other $350,000. So cost to complete would mean it's $500,000. But where this really starts to matter is as you start construction, or maybe you get a third of the way into the building process, and you go to the bank and you say, okay, I'd like to now take some of that $350,000 and pay my trades or pay for my materials. And the bank says, great, we'd love to give it to you. We're going to send an engineer or an appraiser out, and we want them just to check on the status. We want to make sure that you said it was going to cost $500,000, and now that you're asking for some money, we want to go out and make sure that it's still going to cost in total $500,000 to finish. Well, if the appraiser or the engineer goes out and they see that maybe you made some changes to the drawings, or maybe you added another level, or maybe you've somehow made a material change that has now increased the budget from $500,000 to $550,000. Then the engineer, the appraiser, goes back to the bank and says, whoa, cost to complete on this mortgage, the entire budget's actually $550,000. The borrower put in $150,000. You, the bank, have agreed to lend $350,000, but guess what? Because of the changes they've made, they're now short $50,000. And the bank goes, oh, no problem. They go back to the borrower and they say to the borrower, look, before we give you any money, we need to see that you've made up the difference on the cost to complete for this project. So before we give you any money, we need you to put up $50,000 to cover the difference in the changes that you made, or we need to renegotiate the construction mortgage that you've asked us for. So the bank wants to make sure, and rightfully so, I think, the bank wants to make sure that there's enough money to finish the project at all times. The bank always makes the assumption that you, the borrower, have the opportunity to default on the mortgage if life didn't work out. And the last thing that a banker wants is to take back a project that's half completed, and not only half completed, but there isn't enough money to even finish it. Even if the banker was to give the rest of the money available under the mortgage, because of the changes and some of the difficulties that happened on the site, that if there's not enough money, then the bank now has to figure out where are they going to get the rest of the money to finish building out the project. So cost to complete is a term you might hear all the time. It's actually not a complicated term, but it is important to understand what the implication is. So at the beginning of a construction mortgage, make sure you know your budget. Make sure that you feel very confident in the numbers that you're using, because as you begin construction and you ask the bank to release funds to you to pay for your bills and your costs, if there's been any changes, if the price of concrete goes up, or if you've added a couple more walls, or you've changed the design that has in turn changed the budget, then you have to be prepared to either put that money up yourself, whatever the difference was, or you'll have to go back to the bank and say, look, our original budget was $500,000, now it's going to be $550,000. Would you guys consider lending us more? Here's a real-life example of a construction mortgage that went wrong. And believe it or not, in 18 years, I've seen this more times than I care to count. So here's basically the lay of it. We've had a file sent to us from another mortgage company because they weren't able to find this particular borrower any money. He is building an estate home, so this is a home that's worth a couple of $1 million. And he borrowed $500,000 to date, and is about 50–60% complete on the property, but he's run out of money. The $500,000 that the original private lender gave him has run out. His own resources are gone. He doesn't have any more cash really to pay for the rest of construction, and remember, he's only 60% of the way through. So the file sort of came to us. And the reason I say I see this all the time is because there's a term out in the industry known as loan to own. And that's when a borrower goes to a lender and asks them for money, and the lender says, I'd love to give you this money, but they don't end up giving the borrower quite enough. And the reason they don't give them quite enough is because they want the borrower to go into default so that they can take the property back. So if we think about this project for just a moment, this is about a $2 million property. It's about 60% complete, which means it's worth about $1.2 million, as is where is. And the lender has only lent $500,000 to this particular borrower. Well, if the lender was to foreclose right now, there's a very strong argument to be made that they would end up taking back this house that's worth $1.2 million, not completed, for about $500,000, and the lender would hire a new contractor, finish out construction on the property, and end up owning a $2 million home for something significantly less than $2 million. So this happens all the time. Loan to own transactions are something that you have to be careful of. You have to make sure that if you're in this situation, that you know the lender can lend you the rest of the money, that even if they give you a term sheet saying, oh no, we'll lend you everything that you need, that you read the small print, or you get somebody like your lawyer to help you make sure that there's nothing that would stand in the way of them giving you all of the money they've committed to giving you. So in this particular case, we're going to be able to fund a construction mortgage for this borrower so he can complete it and complete the house and sell it and hopefully make his money on it. But he is going to end up paying quite a bit for this money. The interest rate is going to be higher because he is coming to us at the last possible moment. There's bills piling up, there's expenses, there's threats of liens being registered on the property. He's going to pay higher interest, but he's also going to pay higher fees to whoever the lender is that comes in to ultimately fix this problem. So the borrower has already lost probably a lot of sleep, but more than that, they've lost equity. They've lost some of their own cash because now they've had to pay for fees and interest again, and all a result of really just not understanding what they needed to do when they first took the mortgage and how to properly plan for it. So that's a real life example, and I can tell you it happens all the time. So make sure that it doesn't happen to you. Today, I wanted to chat a little bit about the Royal Bank announcement that they're giving employees preferred pricing. On some level, I find this a little bit humorous because it seems like kind of the classic marketing gimmick where someone thinks they're getting something and they're not really getting anything, but because of how it's packaged and how it's designed, that someone feels good about whatever it is they have. So Royal Bank is kind of the first lender to come to the marketplace, which is a very competitive marketplace. Residential mortgages in particular are very, very competitive. Consumers, all they care about, rightfully so, one of the things that they should care about is the interest rate that they're paying, and so that's kind of, our whole industry competes on interest rate when there's actually some other things that we could be competing on. But that aside, Royal Bank is the first lender to come out to the marketplace to say, hey, we're going to give employees preferred pricing for any of the mortgages that they switch in from other lenders to us. So if you work at Royal Bank, but you have a mortgage with TD Bank, because maybe you got it a few years ago, that Royal Bank will let you switch the mortgage in and will give you preferred pricing. If this sounds familiar, it's because the auto industry started doing it years ago when I think it was GM and Ford and Chrysler, actually, maybe not Ford, were having troubles selling cars, and so one of the incentives is that they gave an incentive to their employees and called it employee pricing. So now we see employee pricing on mortgages for the banks, and I chuckle because it's creative. I mean, it's an interesting way to stimulate activity, to drive some sales volume, to push the numbers for Royal Bank, so it looks like they're doing lots of business. The price wars in the market, though, are very real. And so this is interesting because Royal Bank tends not to be the best priced in the marketplace. In fact, you don't need to take my word for it. If you go to the Financial Post, I think there's one article in particular, there's probably a few articles on this, but there's one article in particular where Royal Bank employees or people that have worked for Royal Bank will affirm what I've just said, that it's nice that they're giving employees some preferred pricing, but all that really means is that the employees are getting the same price that everybody else in the market at other banks are getting. So this interest rate issue in the marketplace is very real. Everyone wants to know that they're getting the best interest rates. Banks need to be creative in how they attract new business, but the truth is there's actually lots of ways to get good interest rates, and you don't necessarily need to be an employee of the bank to make that happen. As many of you might know, there's lots of websites in Canada that will lay out for you all of the interest rates from all of the banks and kind of show you how each of them are different. You've got brokers in the marketplace that use their commissions to buy down interest rates. Banks run specials like the 30-day close or the 90-day close, where if you get a mortgage because you're closing on a property in the next 30 days, they'll give you a bit of a discount. So there's just so many different ways to get a really great interest rate. That good on Royal Bank for giving their employees some preferred pricing. If I was any one of their employees, I still want to make sure that I am in fact getting the best rate that's in the marketplace. And how do you do that, right? That's always the question. Many times people will say, whether they're looking for a business loan or a commercial mortgage or a mortgage for their home, they'll end up saying, okay, what's the best rate I can get today? And then a banker or a broker or a specialist will say, well, why don't you tell me a little bit about your credit, tell me your credit score, how much money do you make, etc. So the first step, I think, is to know, where do you fit in the market? Are you an excellent credit risk? Are you a good credit risk? Are you a fair credit risk? Because once you know kind of where you fit on that spectrum, then you can approach a bank or a broker or a specialist and say, look, I've got great credit, I've worked out my income and my debts, and I know that I'm a good borrower for a bank, and so now help me understand who's offering the rates in the marketplace. Why are you telling me that maybe that's the rate I should be going with? Are there any incentives that you're being given to show me that rate? And it's important to know that you'd never really know if you've got the best rate. You know, I guess just to use the auto industry as the comparison, how do you know you've really got the best car in the market? Well, it's kind of subject to, right? If you're an SUV guy and you really like imports, you know, you're going to have a different opinion versus somebody who drives a pickup truck and really likes domestic. Interest rates with Canadian banks kind of all work the same thing. At the end of the day, you're going to get a mortgage with a really great rate on it, much like getting a vehicle that has wheels and an engine and can drive down the road. But do you know you got the best rate? Well, it depends. Mortgages all offer different features. For example, there are things called the no-frills mortgage, where you can't make any principal payments, you can't make changes to your payments, you can't pay out the mortgage unless you've sold the property, and you'll get a really great rate for that mortgage, but it comes at the cost of some of the other things that you might want to see in your mortgage. So at the end of the day, I think there's just too many variables and incentives to know that someone can confidently say, I have the best rate. I think what you want to make sure is that you've got a competitive rate and that some of the other features that you would be looking for have been addressed in your mortgage. So like anything, make sure that you know your options. And with that, we end this Emily Now episode. So to figure out whether or not you're an excellent credit risk or a good credit risk or a fair credit risk, I would encourage you to visit mlenow.ca, where you can enter the mortgage or loan amount that you're looking for and then be prompted through a few different steps to see what your Emily score would be, which you can then match up with the banks and lenders in the market that can fund you. And of course, our customer service team is available on live chat to help you, but you can also send in your request for us to give you a quote or give us a call. We're here to help you do more and would love to see you again.